short view trading. It's Monday 6th of February, it's around 9 a.m. London time. So what matters for markets this week? If you're a swing trader of equity index futures on a 1 to 2 week basis, what should you be looking at to think about whether you should be going long or short this week and how to play these markets? That's what we're going to dig into in this video. So it was a pretty big week last week in global financial markets. A number of equity indices, a number of other indices, key asset classes, look like they might be starting to reverse key trends. Of course, in January into early February, equity indices, S&P500 and the like have been very strong. We've seen very sharp moves to the upside over the course of January, the S&P rallying double-digit percentages from its lows now. But on Thursday, Friday, we reached a key resistance level, the 4,200 level, and reversed off of that on Friday with marked weakness as the payrolls data came in much stronger than expected. But it wasn't just equities, a whole range of interesting asset classes and interesting assets that behaved quite unusually last week, or started to suggest maybe they're reversing a trend and maybe we're getting a shift in the risk appetite regime. And gold was one of those interesting signs, because gold, not only did it sell off on Friday, but it also sold off sharply on Thursday before the payrolls came out. In other words, gold was starting to signalize something on Thursday, and it continued it on Friday, down sharply, as you can see in the chart in front of you now. But also not just gold, we saw a big move in a number of yields across the curve on Friday on that payrolls. We also saw a big move upwards in the dollar over a percentage point rally in the DXY. And so there were some dramatic moves across a whole range of key assets, oil being another one. Actually quite weak over the course of last week, down over 7% on Brent. So what's all that saying? What's the message of that price action? Because interestingly, it was complemented by some weak breadth in the market. If you look at the NYSE advanced decline line, it softened over the back end of last week. And it was also accompanied by a pickup in E-mini volumes. So they picked up quite nicely on Thursday and Friday. So the market's starting to think about something. That's the indicator and the indication of those types of models, that high volume and that deterioration in breadth. And also, we've still got the VIX at very low levels. So really at 12-month low levels, bouncing along those lows, looking as though it might want to pick up and perk up. And of course, with that, you would get equities moving to the downside. So a whole range of asset classes behaving unusually, all of which raises the question of, are we in a change of risk appetite regime? Are the recent trends in markets about to change? Gold having gone up for 3 or 4 months, is it about to enter a sustained downtrend? Equally, real bond yields having been flat for several months, are they about to start perking up again? Added to which is the equity rally that we've seen over the course of January into a beginning of February running out of steam. And indeed, if you look at that rally, the poster childs for it are the likes of Tesla and Arc Innovation and tech in general. And of course, Tesla was off dramatically in the last 3 or 4 months of last year, down about 2/3 in terms of its behavior, but is already up over 50% this year. Having said that, because of the way the maths works, is only back to where it was at the start of December. And the Arc Innovation Fund's behaving similarly. So what was beaten up the most has bounced the most, which suggests that maybe a bit of a risk reversal rally. It may be a lot of short covering. It could be that kind of move that we're seeing in markets. But really, the real question is, are we in a change of risk appetite regime? Is the message of our sell-off indicator, which is ticking above its key plus 20 level, is it one to be paid attention to, and does it suggest we should be cautious here about equity markets on a 1 to 2 week basis? And that is what we dig into each and every day in the daily RAG publication, the RAG Trader, which is available to subscribers. We send it to you over email, but if you're interested in a free trial of that, we're happy to send you that for a few weeks free of charge. All you need to give us is your name and email address. We don't take credit card details until you actually decide to subscribe to the publication. So there's a link below. Click on that if you want the free trial. Otherwise, take a look at your inbox if you're already receiving the daily RAG, the RAG Trader. So what are we watching today and this week? Well, the beginning of the week's fairly light, but the back end of the week there's a lot of macro data coming out that's really quite important, including out of the state Michigan sentiment first estimate. Has it continued to bounce or not? Over and above that, we got some Chinese data at the back end of this week, the total social financing. This is the monthly lending data. Markets watch this closely. It gives a good insight into how much Chinese policymakers want to stimulate their economy. It's accompanied as well on Friday by Chinese PPI and CPI. So key bits of Chinese data, which will be focus of markets' attention. Ahead of that, on Tuesday, we've got Jerome Powell speaking at the Economic Club of Washington. That'll be interesting, especially following on from the meeting last week, a more formal, considered, thoughtful speech perhaps. And then over and above that, it's continuation of US quarterly earnings over the course of this week. So that's it from us. That's your morning market hit for Monday, 6th of February. Thank you for listening. Please do subscribe to these videos on YouTube. Simply click on the subscribe button and like and share on social media, or follow us on LinkedIn, Twitter and or Facebook. Thank you for listening. Stay safe. Trade well.